I just finished backtesting three of the most popular volatility indicators over the past 6 years of historical stock data. The results were completely unexpected. Here's what I found summarized. Now, it probably won't be in 3 minutes because I'm going to give a bit more of an explanation over kind of each indicator, my thought process, but it'll be, under 10 minutes hopefully. Now, I'm Manir, also known as Ghost Trades on Twitter, and I also run Unbiased Trading, an agency where we can backtest and automate your strategies. Now, before we start, each indicator does address unique parts in the strategy implementation. I will cover their basic application and provide a simple historical backtest. However, more advanced testing techniques are crucial for thorough validation of the results, and we'll kind of get into some of those later on in this thread, where I'll give you some examples of what you could test afterwards. Now, number one is the Chaikin oscillator. Now, I mistyped it on this particular thread with volatility, but they are based on the same thing. It's just turned into an oscillator to some degree. Now, overall, it's an indicator that addresses the strength of price movements alongside the buying and selling pressure over a specific period. A reading above zero indicates net buying pressure, and vice versa. So if it's below zero, then it's selling pressure. Now, here's a simple backtest. I made sure to include commissions and slippage that were quite realistic. We were testing over a couple of different futures instruments, so they had different slippage on each individual one. However, for commissions, it was a standard rate. I applied the Ninja Trader monthly rate, which I believe is like $2.50 per particular contract, so it would be a $5 round trip. Now, all it did was two simple rules. When it was above zero, it went into a long position, and when it was below zero, it was in a short position. I tested it across all standard futures instruments, so this is ES, NQ, CL, GC, etc. And this was all done through Ninja Trader. Then this was compiled outside of Ninja Trader, so I exported out all the trades and then put it together into one portfolio equity curve, so it's nice and clean and we can have all the results put into one equity curve for you to look over. Now, as we can see, the general performance seems pretty spectacular. The main downside of this, though, is we are getting quite high returns, but quite a lot of volatility. As you can see here, we go into around $100,000 drawdown. Obviously, this is starting from zero because this is just taking one mini contract on each individual instrument at one time. So there isn't necessarily starting balance. I just normally find this is more indicative of actually how you'll see it plot over because it's not doing any compounding with the account size. Now, while this is probably a good starting point, this definitely wouldn't be a strategy I instantly deploy on live markets for the main reason there's just way too much volatility for my particular trading style. Now, if you were more comfortable with serious drawdowns of 20% plus, then this potentially could be something for you to deploy. However, I would recommend to go on further. You'd really want to run a Monte Carlo simulation. If you're a bit confused about what that is, primarily it is where we take all the trades from a historical backtest and we reorder them. The main purpose of this is to see how much trade sequencing affects performance, because ultimately we want to see, did we maybe just get lucky on this particular backtest? Was it just because of this trade sequencing that it had amazing results? Let's test it over 1,000 other equity curves and see what the median results are. Especially with strategies with high volatility, you'll want to run this test to see how bad this risk of ruin and drawdowns kind of extend if you don't get as good of a trade sequencing when you actually deploy this live. However, we're off to a good start, so let's move down to number two. Now, just before that, if you do want to unlock the skill of backtesting in 2025, I've opened up the Backtest Bootcamp. It will help you save hundreds of hours with proven code templates for different markets. We cover small caps, large caps, futures, and crypto. You'll get to learn how to build robust, profitable strategies from zero. You don't need any knowledge beforehand. And this will ultimately let you build unshakable confidence through data. Now, I've been absolutely blessed to have lots of traders go through it and find it beneficial. This isn't something where I'm trying to sell you a get quick rich scheme. There's no promise of that you're going to make 10,000 per month, after trading for, 1 to 2 weeks. This is about developing a core skill in trading that I have found pivotal in my own trading, and many other traders seem to agree. If you'd like to explore unlocking that skill for 2025 and becoming more of a systematic trader, feel free to click the link below at the top of the description, and then you can find out more details. And there's also a free essential starter kit for backtesting, so you can get some valuable knowledge completely for free. Now, number two is Donchian channels. It's primarily an indicator that helps detect extremes. So when the price exceeds the highest high of end periods, it breaks above the upper channel and vice versa. The Donchian can be used for breakouts and trend identification. It's probably one of the most common indicators I use for any breakout sort of strategies. They work really well in crypto from my personal experience, and they also work amazing on a lot of other markets where you're just looking for very clean breakouts. Now, I would say you're going to normally have to deploy these on higher time frames. If you try and do these on 1 minute, 2 minute sort of time frames, you get a lot of noise. For me, obviously it depends on the instrument, but normally higher time frames, so above 30 to 60 minutes plus, and then, obviously on daily and weekly charts as well. Now, here's a simple backtest, including commissions and slippage, just like before. Now we're going to enter long when price breaks above the upper band, and we're going to exit when the price falls below the middle band. So this is only a long only strategy, and we're just trying to capture breakout movements. Just like before, I tested it across all standard futures instruments on NinjaTrader 8, and this is the equity curve. Now the key thing you're going to be able to see here is I bet you can see where the COVID market started to happen. We can see around the 4,500 trade mark, just performance goes exponential, right? And a lot before that, we're seeing very slow, choppy, also downsending, so going into a drawdown performance. But right when the market turns volatile and breakouts start to work, this strategy absolutely explodes. And you can see it's quite cyclical. So we have a huge explosion in performance around 2020. We then decline a bit during 2022, 2023. We then get a bit of a move up, and then it's kind of been chopping around ever since. So this definitely isn't an ideal strategy to deploy all the time. However, it can be a strategy that, especially if you have it in a portfolio of strategies, this can be performing really well during high volatility, good follow through markets, and then the rest of the time you could try and lower allocation based on performance. That's at least what I've sort of done with a lot of these breakout sort of strategies. Or you can just handle the drawdown as well, and then make sure you have a mean reversion strategy, for example, for different market times. This all ties back into how having a portfolio of uncorrelated strategies is incredibly beneficial. It allows you to smooth out your returns and also allows you to limit or at least reduce some of those drawdowns. Now, number 3 is the Relative Volatility Index. This was created by Donald Dorsey, and it measures the direction of volatility based on price change standard deviation. It ranges from 0 to 100, and above 50 suggests a uptrend volatility, while below 50 indicates downtrend volatility. Now, just like before, here's a simple backtest, including commissions and slippage. We're longing when RVI is above 50 and the price is above a 200 SMA. The main reason I added a 200 SMA on this one was directionality with just using the RVI wasn't very effective. So I thought of just adding a simple kind of regime checker, meaning that if we're above the 200 SMA, then we're going long only, and if we're below, then we're going short. However, still performance wasn't that great. I never really found many variations of using the RVI, at least with my quick testing, that seemed incredibly profitable. We can see here that it did okay for the first year or two, and then it just absolutely faded and gave away all the profits, and also went into a $40,000 drawdown below the equity starting level. Since then, it has moved up, but personally for me, this is way too much volatility, so this wouldn't be something I'd particularly be trading. Now, if you are interested in backtesting these ideas further, please sure to employ more advanced checks. Now, I do have other videos on this channel around more advanced techniques like Monte Carlo simulation, walk forward optimization. I'll probably be updating these over time as I know more people are discovering this channel. So I'd like to reintroduce those topics and also maybe add some follow-up points for anyone that's been using them for a while now. But the main things you really want to be doing when running these strategies is you want to be doing walk forward optimizations, you want to be doing Monte Carlo simulations, and you want to be doing parameter sensitivity to test the robustness overall for the strategy. There are some other techniques and other things you want to pay attention to, but I think as a general starting point, I think that will get you quite far. Now, I hope these ideas can give you some inspiration for your own strategy development. One of my favorite sentences I've ever been told is that curiosity is the biggest edge. So I try and create a lot of these videos, not for giving you cookie cutter things that you can just, place and then make instantly lots of money, because realistically, most of the time, those are never actually true. I want to give you inspiration for how you can improve your trading, what other ideas you could be exploring to build out your portfolio of strategies. And if you find this sort of content valuable and want more every single week, feel free to follow me on Twitter at GhostHawkTrades, or feel free to subscribe, and I hope you have a great rest of your day.